So look, we don't focus so much on the market as individual stocks. So we're very much a bottoms-up stock picker. However, most companies that we look at in this environment are quite expensive by any valuation means. Now, one of the reasons is because interest rates are so low, and I guess that is a factor. And certainly in Australia, they look to be going lower, which means that duration assets should be worth more. That's just a natural mathematical equation. However, there is a chance that interest rates won't be at this level forever, and that some of the reasons why interest rates are being lowered in this country are fundamentally that things are not so good. So it's possible we could have some shocks, particularly from a very weak mining sector, and some flows into that. Finally, the weight of money from investors capitulating and converting their term deposits into units in equity unit trusts, and myself, our own business and many of the other wealth management businesses are experiencing this big flow of cash into our businesses, is creating all kinds of pressures in the market. And what I mean by that is, at the end of the day, if index-hugging fund managers are receiving more dollops of cash, they have no option, because they have to be fully invested, than just to keep buying stocks. Now that creates a dilemma for us. We're absolute return fund managers. We're index agnostic. So we don't like to just chase things that are expensive for the sake of being invested. And as a result, we've built up quite a bit of cash. Not because we're trying to time the market, but because there aren't a lot of opportunities to preserve capital and at the same time make money. In addition to that, where we are invested, our investment theses are being tested because their valuations are starting to get quite high. Now, we've done two things around that. One is we've sold quite a few stocks, so we've crystallized quite a few of the profits, only because they no longer meet our valuation criteria. And secondly, we've bought puts on the market, 6-month puts, 5% out the money, as insurance against a major sell-off. I hope and pray that we can tear these puts up as worthless. If you insure your house for a fire, you don't want to exercise your insurance protection, but it's nice to have that, and it helps us bolster our investment thesis because we've got that side of the valuation issue covered.